Surging energy risks, sticky inflation, and an AI spending boom are colliding just as volatility picks up again across assets. Welcome to vTalkInsight, Allocator's Lens Daily for June 11th, 2026, where we connect equities, rates, credit, currencies, and commodities into one portfolio view. Let us start with equities, where strong earnings are meeting a much more complicated macro backdrop. In equities, the dominant tension is between very strong earnings and mounting macro and valuation risks. Corporate results have been robust, with S&P 500 earnings up around 29% year-on-year against expectations closer to the low teens, and roughly half of that growth coming from non-AI businesses. Forward projections remain constructive, with earnings growth for the index expected in the mid-20s this year and low teens next year, helped by expanding profit margins even in a high-inflation environment. Under the surface, the AI infrastructure build-out is still a powerful tailwind. Chip makers are seeing exceptional demand, as illustrated by a major foundry reporting roughly 30% year-on-year sales growth, while a $4 trillion investment wave in data centers, power, and connectivity is spreading benefits to software and cloud providers such as Snowflake, Datadog, and Oracle. AI monetization is gradually moving from pure hardware into the data and software layers, suggesting that the set of equity winners is expanding beyond the initial semiconductor leaders. At the same time, concentration risk is high. Around 80% of May's S&P 500 gains came from just the top 10 names, and upward earnings revisions are still clustered in those mega caps, which now trade near historical valuation extremes. Semiconductor earnings revision breadth has already started to roll over, and the tech complex is showing late-cycle behavior, with elevated volatility and sharp moves around any sign of decelerating growth or equity dilution. Equity supply is another important pressure point. Large capital raises, including multi-billion-dollar offerings from major AI hardware and platform companies, sit alongside a blockbuster SpaceX listing that is multiple times oversubscribed, with institutional orders reportedly in the hundreds of billions. Rapid index inclusion and rebalancing around that deal, combined with other mega offerings, could temporarily divert capital from existing tech leaders and inject non-fundamental volatility into indices over the coming weeks. Price action reflects this cross-current. After one of the strongest two-month stretches for U.S. equities since the 1950s and a quarter in which about 85% of companies beat expectations, recent sessions have seen the S&P 500 pull back and volatility rise toward the low 20s, even as breadth remains healthy and capital rotates from overbought semiconductors into transportation, energy, industrials, financials, and more reasonably valued names outside the top 10. Asian equities, by contrast, are under pressure ahead of key U.S. inflation data. European banks are positioned as beneficiaries of higher yields and steeper curves, while consumer discretionary and real estate in Europe remain underweight given softer macro indicators. Putting it together, the medium-term equity story is still anchored by earnings and AI-driven nominal growth. But leadership is narrowing, and the market is more vulnerable to shocks from inflation data, energy prices, or large equity deals, which sets the stage for rates to play an even bigger role in the narrative. In rates, the focus is firmly on a higher-for-longer destination with growing uncertainty about the journey. Headline U.S. inflation has reaccelerated to just above 4% year-on-year, the highest since 2023, while core prices rose modestly month-on-month but remain close to 3% year-on-year, with services inflation proving stubborn. This reflects a mix of negative supply shocks, from Middle East energy disruptions and higher freight costs, and strong demand in areas like AI-related capital spending, all while wage growth lags consumer prices and squeezes household purchasing power. Bond traders have responded by increasing bets on further Federal Reserve tightening after a strong jobs report, treating incoming inflation data as pivotal for whether another hike is needed and how long restrictive policy persists. Some scenarios now push meaningful rate cuts out toward 2027, while another camp still sees scope for modest easing later this year if the labor market weakens, though the anticipated cutting cycle has clearly lost momentum. For now, inflation expectations remain broadly well anchored, supporting Fed credibility and allowing policymakers to move more gradually than the headline data alone might suggest. The yield curve is caught between these forces. Market participants generally expect the 10-year Treasury yield to to finish the year near the mid 4% area with limited downside, as investors demand extra compensation for inflation and policy risk. There is also concern that the Fed may have tightened insufficiently, encouraging a potential re-steepening of the curve as term premia rebuild, while investors continue to favor short to intermediate maturities and cash, seeking carry without making large duration calls. Record sovereign issuance adds another layer, raising questions about the market's capacity to absorb supply without crowding out private capital. At the same time, the positive correlation between equities and bonds since the recent Iran-related flare-up suggests that government bonds are less reliable as shock absorbers when inflation and energy risks dominate. For allocators, that means the risk-free anchor is still there in yield terms, but the hedging properties of duration are less predictable, which pushes more attention on a credit quality and alternative diversifiers. Turning to credit, public markets remain remarkably resilient even as stress builds beneath the surface in private structures. Investment-grade and municipal bonds continue to see healthy demand, supported by attractive all-in yields that draw in insurance and annuity buyers who no longer need to stretch far out the risk spectrum. Real estate credit in particular is seen as offering compelling risk return, with lenders able to secure low loan-to-value ratios and high single to low double-digit yields, often with bank leverage behind them. Private credit tells a more complex story. Spreads have widened by roughly 50 to 75 basis points, improving conditions for lenders, while outflows from semi-liquid vehicles and redemption pressures have forced some managers to pause deployment, leaving fewer dollars chasing new deals. Institutional allocations, however, are still growing year on year, creating a pronounced dispersion where capital concentrates in higher quality platforms and weaker managers struggle to raise funds. Sector-specific stress is emerging, especially in software, where defaults and recovery expectations for older vintage loans are deteriorating. A large volume of pre-2022 deals, struck at low rates and high valuations, now faces painful repricing as funding costs have risen and asset values slipped, contributing to stuck assets, redemption backlogs, and a growing pipeline for distressed and special situations investors. Private equity more broadly is grappling with a backlog of unsold assets, difficult exits, and normalization of borrowing costs, which is likely to drive industry consolidation and reinforce the shift for financial engineering toward operational value creation. Against that backdrop, the opportunity set is evolving rather than collapsing. Traditional middle-market lenders are stepping into larger deals as some software-focused credit funds retreat, while distressed opportunities are expanding in real economy sectors, such as industrials, chemicals, manufacturing, and non-AI real assets that have been starved of capital as money crowds into data centers. Rising default rates and illiquidity in parts of private real estate and credit are clear warning signs, but they also underpin better entry yield for selective capital, with success increasingly tied to genuine turnaround and operational capabilities rather than leverage alone. In foreign exchange, the dollar remains underpinned by U.S. economic outperformance and the possibility of additional Fed tightening. Persistently high energy prices and solid growth raise the risk that U.S. inflation proves stickier than elsewhere, a backdrop that tends to support U.S. assets and the greenback in the near term. That relative strength contrasts with earlier expectations of rapid U.S. easing and keeps pressure on several rate-sensitive currencies. Japan adds another source of uncertainty. The hospitalization of the Bank of Japan governor ahead of a widely anticipated rate hike clouds the policy outlook, even as the yen trades near historically weak levels around the 160 mark despite those hike expectations. Markets are watching for clarity on leadership and policy continuity, and any surprise on timing or magnitude of tightening could inject renewed volatility into the yen and Japanese assets. Beyond traditional currencies, the role of real and digital assets in the currency mix is evolving. Gold and silver prices have recently softened as markets price in higher U.S. rates and higher real yields. Yet longer-term concerns about fiscal discipline and potential dollar debasement continue to support interest in both precious metals and Bitcoin. The current Bitcoin drawdown is notably shallower than in past cycles, with more institutional holders and entities backed by dollar reserves helping to reduce forced selling, which may gradually embed crypto further into the broader FX and reserve conversation. Commodities remain at the heart of today's macro risks, especially energy. Military exchanges between the U.S. and Iran, including strikes near key shipping lanes, have raised the specter of broader Middle East disruption. Yet crude prices have so far moved only modestly higher, with Brent hovering a little above $90. That muted price response likely reflects a market view that both sides wish to avoid full-scale conflict, as well as announcements of additional barrels being released, even though war-related disruptions have removed several times more supply from the system. Underneath the headline price, the balance looks more precarious. Global oil and gas inventories are being drawn down quickly to offset disrupted flows around the Strait of Hormuz and other choke points, with the risk that reserves are depleted before supply routes normalize. If that happens, even a modest escalation could push energy prices significantly higher, feeding directly into inflation, freight costs, and growth-sensitive sectors such as transportation and parts of manufacturing. Thermal markets and industrial metals add further complexity. Coal demand is surging across parts of Asia, particularly China, as countries restock and expand coal-fired power capacity, and forecasts for a strong El Niño in 2026 point to higher energy demand in East Asia that could keep coal shipments elevated if oil and gas remain constrained. At the same time, the global infrastructure and AI data center boom is driving strong demand for steel, aluminum, iron ore, copper, and related materials, clearly visible in bulk cargo flows and contributing to higher input costs for energy and tech-exposed sectors. These commodity dynamics feed back into broader inflation and allocation decisions. Fertilizer prices are up by roughly a third. Chinese producer prices are rising much faster than consumer prices due to energy and electronics costs, and freight rerouting around conflict zones is lifting transport expenses, all of which reinforce the risk of more persistent inflation. As bonds and equities have become more positively correlated around recent geopolitical shocks, investors are increasingly reallocating from traditional 60-40 mixes toward greater exposure to real assets such as gold, silver, energy, and selected equities, even though near-term precious metal prices are pressured by higher policy rates. For a cross-asset portfolio, this leaves commodities as both a potential source of volatility and an important lever in managing inflation risk alongside decisions on duration, credit quality, and equity sector mix. Bringing it all together, allocators face a market where strong earnings and a powerful AI investment cycle still underpin equities, but valuations, concentration, and a wave of large capital raises and IPOs leave risk assets more sensitive to policy and geopolitical surprises. Rates are converging on a higher for longer regime, with a yield curve and government supply dynamics reshaping how duration works as a hedge, while public credit remains firm even as private credit and private equity absorb a slow-motion repricing. In currencies, a firm dollar and a fragile yen reflect policy divergence, just as gold, Bitcoin, and other real assets quietly absorb some long-term currency and inflation anxieties, and commodities sit at the junction of Middle East risk, AI-driven metals demand, and the path of global inflation. For multi-asset portfolios, the key watch points now are incoming U.S. inflation and labor data, any shift in Fed communication, the evolution of Middle East supply disruptions, and how quickly equity supply for mega deals clears through the system. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.